These are the highlights of our 15th fiscal period, the 6-month period from July 1st to December 31st, 2019. Distributions per unit were 8,892 yen, exceeding the previous forecast by 155 yen. The reason for this is that net income exceeded the previous forecast by 68 million yen due to decreased operating expenses such as property management and building management fees and utility and repair expenses, although rental revenue increased while utility income decreased, resulting in an overall decrease in operating revenue. The earnings forecasts for the 16th and 17th fiscal periods are as follows. The forecast DPU are 9,002 yen for the 16th period and 9,102 yen for the 17th period. We had set achieving 9,000 yen DPU as a target DPU for the 17th or 18th fiscal period in the past. We are now expecting the target to be achieved ahead of schedule. This bar graph shows the forecast and actual DPU from the 5th period on. The orange line shows normalized DPU, which excludes non-recurring factors such as property tax and city planning tax, investment units issuing cost, and gain on sales of real estate properties. And you can see from the graph that it is growing steadily. In addition, the gray line in the upper left of the graph shows NAV per unit, which is also growing steadily. Moving forward, our target of normalized DPU is an annual growth rate of between 3 and 4%, which we will achieve through internal growth. In order to maximize unit holders' value through flexible and timely investments, NIPPON REIT has used bridge funding vehicles as a property acquisition method and achieved external growth through public offerings and asset replacement. Regarding future external growth, while our investment unit price is steadily increasing, we will also keep seizing golden opportunities for public offerings in mind, combining the utilization of our pipelines and asset replacement with new property acquisition, so as to strive for a medium-term target AUM of 300 billion yen. This slide shows the current condition of our pipelines. As a result of the combination of 3 bridge funds and warehousing achieved through sponsors, we currently possess pipelines consisting of a total of 21 properties, equivalent to 22.2 billion yen. In addition, this is the second time we have achieved sponsor warehousing. If we look at these properties by use, a large number of them are residences. This is because there are a large number of residential properties which fit NIPPON REIT's investment principles in the currently heated real estate market. This does not mean a change from our portfolio strategy focused on medium-sized office buildings in central Tokyo. This slide shows our occupancy rate and free rent period. Total occupancy rate at the end of the 15th period was 99.4%, and the subset of our office buildings achieved 100% occupancy. The forecast for occupancy rate at the end of the 16th period includes the termination notices we have received, as of now is 99% in total. We are currently carrying out leasing activities to improve this rate. In addition, our free rent period has remained low and stable, and as a result, the rent occupancy rate is the converging with contract occupancy rate. This slide shows the status of tenants moving in and moving out, as well as the increase or decrease in rent when they are replaced. The graph on the left shows the move-in, move-out area for offices. Continuing from the previous period, the move-out ratio stayed around 2%. There is always a certain ratio of tenants who move out in this business, so we are continuing to carry out vacancy-filling initiatives with awareness of time lag. In the 15th period, net monthly rent increased by 6.33 million yen due to office tenant replacement. For residential properties as well, rent continues to increase at our properties in Tokyo and Osaka, such as Tower Court Kitashinagawa. This slide shows the rent increase or decrease resulting from our office contract renewals. For the 5th consecutive period, there was no downward revision in rent. In the 15th period, the monthly rent increase from office tenant contract renewals was 6.49 million yen. This slide shows the trends in rent change ratio and rent gaps for our office properties. The upper left graph shows the ratio of monthly rent increased or decreased due to tenant replacement, shown on page 16, and contract renewals, shown on page 17. These two factors created a combined increase of over 5%. The increases were 6.33 million yen from tenant replacement and 6.49 million yen from contract renewals, for a total increase of 12.82 million yen. This will result in an increase of approximately 77 million yen over a full fiscal period, which is equivalent to a 171 yen increase when converted to DPU. The source of rent increases is rent gaps. At the end of the 15th period, NIPPON REIT's average per tsubo rent for office properties was 15,172 yen, compared to the market rent of 17,974 yen. Due to the increase in market rent, the rent gap has widened further, reaching minus 15.59%. The lower right graph shows the distribution of rent gaps for properties with upcoming lease contract renewals in the current period and beyond. The navy and blue portions indicate contracts with negative rent gaps. With business environmental advantages, such as rent gaps as background factors, we will work to implement measures such as lifting up tenant satisfaction through engineering management, effectively combining these efforts with negotiations to achieve upward rent revisions. We are continuing to proactively carry out engineering management initiatives. In the 15th period, measures were implemented which produced a DPU increase of approximately 19 yen. Considering rent increases as the main driver of internal growth, we have placed engineering management measures as a sub-driver. Our goal for these measures is set to achieve DPU increases of 20 to 30 yen in the 16th period and beyond. This slide covers our financial strategy. At the end of the 15th period, our remaining interest-bearing debt was 126.87 billion yen, and the long-term debt ratio and fixed interest rate ratio were both 100%. Also at the end of the 15th period, LTV based on total assets was 46.9%, and we will continue to keep it controlled within the 45 to 50% range. In addition, LTV based on appraisal value was 40.8%. In the 15th period as well, we have implemented longer-term refinancing by degrees, balancing revenue and costs. The settlement date arrived for 11.7 billion yen of debt, and this has been extended. Although all-in cost rose slightly to 0.97% at the end of the 15th period, the average borrowing period and average remaining borrowing period were extended to 6.16 years and 3.84 years, respectively. In addition, we have set our commitment line to 3 billion yen to ensure we can respond flexibly to future funding needs. We will continuously manage to control debt costs, balancing with overall revenue.